Well, predictions of just 8% growth, that's a slowdown Chinese style. But hopes are building for another round of stimulus after Chinese manufacturing hit a 9-month low. While some are taking the glass half full view, there are still troubling signs for Australia as iron ore and coal prices continue to slide. Neil Woolridge reports.
The Chinese dragon isn't soaring like it used to, but that doesn't mean it's run out of puff altogether.
We are looking at a 7.8% GDP growth in the third quarter, and at best, maybe the third quarter GDP growth rate year on year will be flattish.
In the latest of a slew of weak economic data from China, the official Manufacturing Purchasing Managers Index fell to 49 points. A reading below 50 means the industry is contracting, and this is the weakest in 9 months.
Most people, when you look at a PMI, below 50, they say going backwards. In China, when you're around 50, you're growing at 9%. So it's still quite strong industrial production, but nowhere near as strong as it has been.
The recent run of soft data is raising hopes that China's policymakers will take further action after interest rate cuts in June and July failed to have any immediate impact. But even if another round of Chinese stimulus works, there are still worrying signs for Australia's exporters. HSBC's unofficial PMI shows that China's inventories of finished goods now stand at record levels.
It's migrating into a new phase of 5-year growth plan of infrastructure spending and public housing. And that in itself means the demands, the robust demands for commodity prices won't be like it was, say, in that going into the GFC or that period of stimulus in 2010.
Here in Australia, there are signs of improvement, albeit from an extremely low base. The local Performance of Manufacturing Index rose from 40 to 45 points, still well below the 50-point line that separates contraction from expansion.
If the RBA stimulate further, that is a positive, and if the Aussie dollar does not migrate sustainably higher, that will be positive, because the reality is costs will still remain high in their local economy.
So the miners, the farmers, the health areas, the professions are still doing really well, whereas construction, retail, manufacturing, particularly residential construction, all doing extremely tough.
The weak data from China is starting to take its toll on the Australian dollar, which has lost nearly 4 cents against the greenback over the past month. And the Reserve Bank's commodity price index fell another 3% in August, taking its losses for the year to nearly 14%. However, NAB's chief economist Alan Oster says there's more to the commodity price index than just the well-publicised plunge in iron ore and coal prices.
Whilst the iron ore price has been going down, things like agricultural prices were actually up substantially. I still think net you're probably going to get a bit of a fall in commodity prices, and net I think the terms of trade are clearly coming down, and we'd expect them to go down another 10% or so.
And by some estimates, cheaper iron ore and coal are already likely to cost the federal and West Australian governments around $1 billion each this year, even if commodity prices don't fall any further.